Hi, everyone, and welcome back to another episode. My name is Tyler, and I'm with Matt, the founder of Orats. Orats is an options analytics platform built on top of over 15 years of historical options data. And our platform is integrated with Tradier, meaning that you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Last week on the show, we focused on finding a back-tested trade where we found and submitted a trade for a SPY long put diagonal. So today we'll go over how that trade went and then talk about today's topic, which is finding a wheel trade. Matt, if you're ready, do you want to share your screen and go over last week's trade?
Sure. Hey, Tyler. So every week we get on and we pick out a strategy and how to find a trade. The first week was an earnings trade. We had Palo Alto Networks and did real well on that one. It was a calendar, and we got out for 187%. So got in for 72 cents, got out for $1.33. So here's the Orats dashboard. That position closed out. So if I go to positions now, in our paper trading, we have that one position that we did last time. It was a long put diagonal that we got from our trade ideas. It was a short delta trade, still open, but the market rallied, so it's down. So we're down a quarter on that one. We're up $1.33 in the other one, so we're up a little bit overall. So yeah, that's how we're doing, Tyler.
Awesome. So thanks for going over that, Matt. This week's topic is the wheel strategy. And we're going to find a wheel trade, and we're going to look at some back-tested wheel strategies as well. So I want to go over quickly what is the wheel strategy in case you didn't know. So the wheel strategy is a premium generating strategy. It's usually done on like a weekly or a monthly basis. And ideally, you want to do this strategy on a stock that you're comfortable owning or a stock that you're neutral to bullish on is kind of the ideal stock. And the reason it's called the wheel is because there are two parts to this strategy. And you're sort of looping between the two. So the first part is selling a put, and the second part is selling a call. And since you're selling both, you're getting a credit both times, which is why it's called a premium generating strategy. So you start by selling a put on the stock, which is normally done on on the at the money strike or a few strikes out of the money. And then you'll continue to sell this put until you get assigned the stock. So if you sell a put expiring in a week and then it expires worthless, you'll just do the same thing next week and sell another put. And you'll do this until you get assigned. And then once you get assigned the stock, you'll start selling covered calls, which is the second part of the strategy. And you'll continue to do the covered calls until the stock gets called away. And once that happens, you sort of repeat the whole thing, and that's the wheel. So what we've done at Orats is we've taken this multifaceted strategy that has basically two different strategies in it, and we've back tested it, which is quite a technological breakthrough, I think. So Matt, you're sharing your screen. So you're on the back tester. Do you want to walk us through the wheel back test?
Yeah. So let me just add a little bit to what you're talking about, the wheel. I mean, you see a lot of people out there. It's quite a popular trade. And there's a lot of people that are talking about the wheel strategy online and mentors and such, but I have never seen a back test on the wheel. So we put our heads together at Orats. We've been back testing for a number of years, but we never had the wheel because it's a combination of strategies, and we hadn't done that before. So we got together and did it, and so we've just released it not too long ago. We have it on two symbols, SPY and IWM so far, and it's really neat. There were some challenges. How do you present it? So the way that we presented it is, so we showed. Let me zoom in a little bit. So this is a wheel strategy. This is in our back tester. Our dashboard product contains all of our tools. So the back tester, you come in, you could choose between a lot of symbols, strategies as well that we've run. So the wheel strategy here, the way that we present it, it's two different strategies. So this is, with a vertical line, we separate the days to expiration, for the calls and for the puts are different, and so are the deltas. So this is how we present it. So we're sorting it in terms of one of the you could sort of with a lot of things, just annual return, but I like to look at how you did versus your risk. So if you hover over this informational tab here, it shows that this is basically the daily P&L divided by the worst things that could happen. A Calamar ratio, I believe, is a max drawdown as your denominator, but here we have max drawdown, worst annual return, and worst monthly return. So it's a lot like the Calamar ratio is what I like to use in order to identify the return divided by that. So the best one you could tell. So here's the annual overall performance average since 2007. So it's about 6%. There are some much higher, but again, there are larger drawdowns. So we have things like time in the market, annual returns the last year, 5 years ago, during bear markets, during bull markets, Sharpe ratios, Sortinos. But what I wanted to show is a max drawdown here is what I like to look at. So this max drawdown of that good one is it had a great return, but it was 28% drawdown. Now, and then the worst monthly return. So you look at those too, because can you handle that as a trader? So what do you want to, so I like to minimize those and then maximize the results based on that. And then then you could compare that to just this is a SPY long stock that had a 62% drawdown percentage. So so that's what you're kind of comparing to, and then the Sharpe is about 0.69. So we want to do better than that in this strategy if possible. So let's take a look. So again, we start off with a lot of different days to expirations. We just kind of spread it out. You could see some up to 111 days, and you could see that there are deltas from 90 down to 2. So what you might want to do is as you mentioned, Tyler, traditionally it's been like selling a 40-35 delta, something like that, put, and then when you get assigned on the stock, then you sell a call against it. So that's the right-hand side of this vertical line here. And that's a 90 delta. So that's a kind of interesting. So let's take a look at this back test. The immediate thing that I don't like about 2 days is that we haven't had weeklies that long, and we're going back to 2007. So it's going to skew the results. So we're going to probably end up filtering those out. But so if you look at this trade, this is our back tester, and we have performance results. There's the 5%. There's the drawdown that we talked about. We have a risk reward kind of average per trade, and then annual returns of the last year, and a lot of the things that we've looked at so far. Drawdown's not very much in this. This is great, but again, I think this 2 DTE. If we look at the trade log, back in 2007 to 2008, there weren't that many trades because we didn't have weeklies back then. So what I'm going to do is I'm going to ignore this trade. I'm going to put a minimum. Let's put a minimum of 15 days for the puts, and we'll do the same for the calls to a minimum of 15 days. So I don't know if you saw that, but there's a drop down where we allow, there aren't any 3-leg or 4-leg, but so we've put that in. So we've kind of filtered those out. And also I want to, so now we have a 2 delta. Let's just take a look at that. I'm going to end up filtering this out, but this 2 delta, you got assigned the stock here, and you never really got back into the stock. Right here you did, but so that's a little path dependent. You have something so far out of the money. So again, I'm going to filter out those small deltas. We put them in there just for to to take a look at them, but let's have a minimum of 15. We'll even do a maximum of 70 for the puts.
Hey, Matt.
Yes.
So I just want to clarify. So the leg one is the short put. That's the first half of the trade, right?
Right.
And then leg two is the short call. So that's sort of what we're filtering on here.
Right. So now the favorite for my best return on risk is the 16 delta and a longer put, so longer dated put, and we'll take a look at that. And then there are problems with the longer dated put that we'll talk about too when we look at So this looks like a decent trade. If you look at the drawdown, maybe a little bit too much, 26%. But not nearly the drawdown we saw in the great financial crisis here. So the problem now with the 111 day is you just don't get that many trades, only 3 per year or something. So again, this might look nice and it could be a viable strategy, but we don't really have enough trades to make a good decision. So I'm gonna put the max at 75 days, so we'll get something more typical in here. I need to do it for both. So 75 days. And then, there are 83,000 back tests that it's sorting through. So this is interesting. So it's selling an at the money put and then selling an in the money call 75 days out. So let's take a look at that. All right. So, again, I think the good thing about, having a wide look at a wheel strategy is I wouldn't have considered doing this strategy, so let's take a look at at what's going on underneath the hood for this one.
I like that there's not as much of a drawdown in that early 2020.
There's not that much of a drawdown here either, so let's look at why that happened. So let's look at the trade log, because in 2008 and I'm just clicking on these hyperlinked years, so it makes it really easy to go in. So we did get called away a couple times. So here's a bigger one. So let's go through this trade. So this was in July of 2008. The entry price in July was 125, and so what we did is actually we should look at the trade before that, because this is where we got called away. So, a 50 delta put, we sold that while the stock was 131. So that's the 132 puts. So slightly in the money. And then, so we got $3 for that. The stock went down to 125.98. And so we lost 292, but we were called away. And then, so we valued that stock at the strike, 132, and then we see what happens. So then we start selling calls. So here's the first call, the first call that we sell. Again, it's a 75 days. So within that 75 days, we got these dividends, and we were able to sell 1, 2, 3, 4 calls here, and even though the stock went down, we didn't get called away because the stock went down during that year. So
we were making premium from the covered calls, so it kind of offset our losses a little bit. And it looks like we were also taking dividends from the stock that we were owning. So those are also listed there.
Exactly. So they all offset. So just owning the stock during 2008, we lost $3,000, but selling the calls, we covered half of that. So, that's a lot of the reason, Tyler, for the limited drawdown, is that we were selling these meaty calls, $12, $10, $9. So that really did cushion the blow. So,
definitely.
Kind of nice. And it's almost like, if you have a long stock and then you have a short call, that's just like a short put. so if you look at the payout picture, then that's assuming that you learn when you learn options. But so it's just like continuing to have a short put out of the money. So, and then, so after this, stock was down at 74, and then it went up to 88, and then we got the 68 call was called away. So then, so that was in May. So the next trading day that there was an available trade, we went back and started doing the puts again. And, so we made it on that put, we made it on this put. So, we were selling, pretty meaty puts and, getting paid for that. So 2008, 2009, that was a pretty nice time. We could look at, this is how hedge funds tend to view their returns. So these are all monthly returns, and the years are down here. Annual returns are here. So, you only lost 11.89% in 2008, and you could, contrast that with, 37% in 2008 with just the stock. So, this is an interesting one. So I might save this to my favorites. I could find similar back tests, scan for options on this particular strategy. This looks decent to me.
Yeah, I like that one. And Matt, can you pull it up again? I want to show something on the graph. So if you kind of want to match the returns from a graphical perspective a little better, you can change the percent of starting capital to be used on each strategy trade. So this is important for a premium selling strategy like the wheel, because the more money that you put at risk, the more you're going to take in from the premiums, and that's going to adjust the graph in terms of how you're looking at it versus the stock. So so Matt just changed it to 50%, meaning that if you had $100,000 account, you'd be investing, or you'd be risking $50,000 on this trade. But keep in mind, you're selling the puts. So if you get assigned the stock, well, that's how much you'd get assigned. You'd get assigned about $50,000 worth of the stock, and then you'd own it. So it's not as risky as, putting $50,000 into a long call where you could lose it immediately.
Right, and you could see, levering up a position, if you have a good Sharpe ratio. So the Sharpe ratio is 1, which is, quite a bit higher, 30% higher than the long stock. So, and you could see that in the drawdown. So the 2020 drawdown, great financial crisis, so it withstood some of those drawdowns better than the stock did it itself. So again, interesting position here. Anything else for this one, Tyler?
Do you want to do the scan for options yet, or do you want to look at some more?
Sure. I mean, if we scan for let's. Oh, I see what you're saying. Yeah. So
because that's going to look at if you want to put a trade on, that's going to scan for the first part of the trade, which is the short put.
Right. So let's try that. So the cool thing about this is it goes from the back tester tool to the option scanner tool, and automatically fills in the days to expiration that we were looking at, the deltas that we were looking at, and then we could go find a short put. So the top one here, you could sort it based on rankings. You could put forecast value in, smooth value in too. They're all pretty similar type of strategies here. So let's go ahead and click on this one and take a look at it. It's the SPY short put. We have our trading account. We have our paper trading account. And we're 10 days out, so that's on the shorter side. We do is take a look at this stock. The payout picture, of course, is here. So we can now review this order. Let's do one lot here and confirm and send that trade to the market. And you could tell how this is our paper trading. So we're working that order. We have it at 280. So let's try to let's try to replace that and try to be a little bit more aggressive. That's aggressive. Anyway, so we'll get a fill on that, and then we'll take a look at that, next when we come back next week. So let's go back to the back tester and check out some other things about the wheel strategy. So another thing I like to do with the wheel strategy is look at the worst kind. So one of the goals today is to learn more about the back testing the wheel strategy and about what you might want to do. So immediately we've learned that that a strategy like this one minimizes some of the drawdowns, which is nice. But let's look at some of the worst ones. Maybe we could learn from looking at the worst ones and see why they didn't do so well. So in contrast to the strategy that we're choosing now with a near at the money, this is quite a bit out of the money. As a matter of fact, it kind of bounces up against our minimums that we put in. So so right now it's kind of, my intuition is kind of saying, well, if you're not getting enough premium and you still lose a lot, that's the bad thing about this particular trade. So I mean, especially let's go look at February 2020. You can see the date down there.
Yeah, I mean, the graph shows it pretty clearly. I mean, it was just not as, the returns were just much more flatter, just because we're selling more further out of the money and not getting as much premium.
Exactly. You don't get the premium and you still have a lot of the risk. So, for, you only sell this for $1.65 and this is the bad trade. So, it goes from 336, the SPY was 336. It went way down to 222 over that kind of, month in 2020. Obviously we know that COVID crashed down, and you had the March on that, which is probably the worst time, but that's the position that you had on. And then, so then you got called away. So then you said, okay, well, we got the stock. And now let's do the call. So the call is 75, DTE, right? So now you're selling a call and it kind of immediately goes in the money, but you're not, you're not able to, get more and more money for it because it's a long-term trade. So it kind of does a lot of things wrong, which is what we want to learn when we're looking at the wheel strategy. So we don't want to do this. We don't want to do the strategy where you're, even though you made money at that point, you could have made a lot more had you sold and shorter dated options than this. And then you go along your merry way, and you're making a lot of money on these puts that you're selling out of the money, and you're thinking it's a good strategy. But again, what we learned about the strategy is when you do lose money on it, you lose a lot, and it's hard to make it back up. So one of the lessons that I've learned by looking at the back tests is that you want to have some higher premium that you're selling. So the ascending 16 days, 50 deltas, that's pretty nice. And 70 deltas is a fair amount of premium to get when you have the call. And we could start to look at some other strategies as well. One of the things I like to do is look at similar strategies. So let's try that right now. So if you go to the back test and you have a back test that you like, you could click on find similar back tests, and it will find all the ones with the same entry indicators, strike width and stuff. Even though some of these we didn't use, we could find similar back tests there. So there's only that one. So then we're going to have that. Now we'll start to widen things out. So we'll go 10 days to 25 days on leg one, and we'll go from maybe 45 to 12 on leg two. So we're expanding these. Leg one will go from maybe 30 to maybe 70, and then on leg two, we go from maybe 50 to 80, and there aren't any entry triggers or anything else for these. So So now these are the similar back tests. So what you want to see when you're looking at similar back tests are, good results. And so what I'm seeing are pretty consistent and good results. So, what it looks like to me, Tyler, I don't know what you see, but it looks like these are
Yeah.
pretty good. So
Those
let's
look
just
pretty
look.
consistent. And
Yeah,
and so one of the big reasons you're doing this, and this is why the backtester is so amazing, is because you can see if you're overfitting, essentially. Because
yeah,
if you had really bad, like you just sorted by descending, if some of these returns at the top were negative even, then it'd be a sign that the back tests were overfitting, because you're
right.
seeing wildly different results for basically the same or very similar entry criteria. And so you just want to make sure that you're not overfitting, and that's a good way to check for that. And that's essentially what Matt's doing here, is he's seeing, is this a good strategy, just conceptually, or are we overfitting or not?
Yeah, good. So even these bad ones, and this isn't the strategy that we're doing. This is selling 16 day in the money puts. So maybe that's a little bit too aggressive. So maybe we could just take these down to 55 deltas and then see what the worst ones are. So here's 40, 80, and then 80 is a little bit aggressive there too. So we'll lower that to 70. And then you have pretty consistent results with what you have, for your existing strategy that you liked in the first place. So again, now I feel more comfortable with the strategy that we've chosen, that we're not overfitting as much. I mean, obviously the SPY went up during this time frame, and you need to keep that in mind. But what I've kind of learned is that you need to be more aggressive on the put selling in order to get the money for when it actually does go against you, and then you're aggressive on the call selling, so you can protect your stop, from drawdowns as well. So, do you have any observations like that, Tyler?
I mean, those are some good lessons, and that's the important part about backtesting, and that's why we focus so much on it, is because you hear a lot online, like, what's the best thing to do for a real strategy, and these people are just they're just saying what their experiences are, but with backtesting you can see real results, right?
Yeah, and really, you want to be really careful about your drawdowns. I mean, whenever you're trading, that's the big thing. That's why I've chosen the best return on risk, in order to compare these strategies, and it really looks at the max drawdown, and it looks at worst months and worst years, and that's what this does well, which I think is actually quite interesting, is that the type of strategy up here are the ones that minimize the volatility and drawdowns and stuff. So I think we got a pretty good wheel strategy to watch. So we'll be keeping an eye on the strategies and going forward, and when to get in, when to get out, when to sell the call if we ever get called away. So I think it's going to be a lot of fun for people to follow along, Tyler.
All right, I'm excited. Thanks, Matt, for going through that. That was a great review of how to find a wheel trade on the Orats dashboard. And we sent it to Tradier, so we'll have some stuff to go over next week. As always, if you have any questions about our tools, you can email us at support@orats.com. And all of our tools are available on our website as well at orats.com. All right. Thank you very much to Tradier for hosting us on your show. And we'll see you guys again next week.
Thanks, Tyler.